I don't think I'm sounding optimistic. I'm thinking that the Fed and the market overall are sounding optimistic. Let me just elaborate on that. I think we're just buying into three different sub-stories. The first of which being that basically we can get rid of the current inflation we're seeing without unemployment to rise at levels that could be a source of worry to us. And with that, the second story is that with the lower level of equities, well, basically, it's a very good entry point when you come to think of it. And the last story is we just need to wait for the Fed to pivot to start buying into equities. That is these Goldilocks stories that you just framed. I'm saying that this is a core scenario of markets. I'm also seeing a lot of risks attached to it. And the main risk to that is basically that we wouldn't be able to orchestrate a soft landing, but we would be served a hard landing. And this whole stories actually would go wrong.
Florian, very interesting. So what is a Fed pivot? Karen and myself have pontificated on this for a long time. A Fed pivot used to be cutting rates. Then it was holding rates. Then it was, we're just going to increase rates at a lower rate. What is a Fed pivot nowadays in your interpretation?
We need to be fair. When the Fed pivots, it means it's thinking of cutting rates. Okay, and usually it does so because the macro situation is going south. That's why in the last of the three stories I just told, the last one is potentially where the fragility is. Usually, historically, but in 2019, historically, when the Fed pivots, when it starts considering cutting rates, it doesn't mean that things are doing great. And it's usually not the moment to buy into the equity market. Actually, quite the opposite. The Fed does so, the ECB does so to protect us, to create a floor under our feet. And it's not the right moment to start buying again into equities in that moment.
Bring up the data. We've got some backward-looking data in the terms of the jobs data, some forward-looking data in the form of the PMI services data, and both indicating that there's still this underlying strength in the US economy. What does the market do with that? Because they've been stressing about it for a number of days.
It's even worse than that. It's very likely that, according to the nowcasting indicators we're looking at, the U.S. is already in a recession. So we expect the NBER in 2 years' time to be dating the entry point of the current recession, say Q4 or Q1 next year. Now, what we tend to forget is that the first few quarters of a recession can be periods of growth, meaning positive GDP growth. But the mechanism of recession is that you see an increasing number of weaknesses across different sectors within the economy. The employment market is not as great as what it was a year ago. The housing market is also going down. PMI's expectation, especially industry level expectations, are ahead of that. Now, what's lagging is, of course, the level of unemployment, which is typically a backward-looking data, and service. We've been used in 2020 to considering that service could be a cyclical industry. Usually it is not. It is a lagging industry because basically we will keep on using our services. That's not the first expenditures we're going to cut in a period of recession.